Wholesale prices for June rose more than anticipated in another sign that inflation may be moving at a faster tick than the markets had priced in. This comes on the heels of the biggest jump in CPI since 2008. Fed Chair Jerome Powell insists that inflation is still transitory and will moderate, and says that the central bank has no intent on changing its monetary policy for now. We're going to get Jon Najarian's take on this today. He is the founder of Market Rebellion and a frequent contributor to CNBC. Jon, welcome back to StansberryInvestor.com. Good to see you.
Great to be with you, Daniela. Thank you so much.
So let's get your take on this. Jerome Powell saying, hey, let's not panic here. We're not going to change course of action. But what say you, Jon?
Well, I'm not saying that he and the other members of the Fed should panic, Daniela, but I do think, just as Larry Fink said yesterday, that it's not transitory, inflation, that is. I think the impetus for inflation is, of course, that people got a lot more money for not even working. And I'm not saying people didn't need it. That's not my point. My point is that a lot of money flowed into the hands of folks. According to Bank of America, only about 30% of the deposits that came in from that stimulus were spent so far. So in other words, look for this so-called transitory inflation to keep running for multiple quarters. In other words, we haven't seen a peak yet. I think we're going to see, instead of 5.4% that we just saw for consumer prices, I think we're going to see 6, and we might see 8 and 9 even. Then I think it settles in at 4.5 for a while, because there's an awful lot of money in the system and a lot of pressures on everything from food and travel to, of course, gasoline prices, which have skyrocketed in the last few months.
So not transitory, but not runaway necessarily is what I'm hearing from you.
Yeah, not runaway, but just like job inflation, obviously people are putting bigger and bigger incentive packages to get people back to work. And in some cases, I've seen $5,000 and $6,000 as far as signing bonuses, if you're willing to come back and drive a truck or unload a truck and things like that. And I've seen iPhones even being offered for McDonald's jobs, as long as you work there for at least 4 months, that you could get an iPhone as a bonus for coming in. And I think that people are not likely to see those inflationary pressures for wages come back down. And again, I'm not complaining about that. I'm just saying inflation is something that the Fed wanted, and they have to be a little careful. What they wanted might be a little more and a little more difficult to get back to sort of a, after we see these 4 and 5 and 6% levels.
And if we focus in on the CPI number, highest jump from 2008 since before the financial crisis, is that something we should really be worrying about here, Jon? Is that a sign?
Well, it is a sign that people are willing to spend. There is more demand than there is supply in a whole bunch of areas. Obviously, when things like lumber got too expensive, Daniela, people found ways to cut back and to not work on that. In other words, they found, okay, I guess I'm going to have to put off working on my house or doing that addition because they couldn't afford it. I think we're going to see things like lumber that have come down in price offset by other things that have gone up, like the appliances. You can't get them from China right now. It's almost impossible to get those appliances without a 4 to 5 month lag. I think that's going to continue. And again, that's putting further price pressure on appliances. We're going to see it in automobiles and used automobiles too.
And on the automobile front, I'm in Canada right now. You can't get German cars like BMW, Mercedes. There's 3-4 month wait for those kind of cars, Jon.
Yep.
So to your point, so let's talk about sectors you're liking right now. What's looking hot to you?
Oh, well, I think eventually we're going to see the banks do much better. They came out, like a house of fire in the first quarter, and then they kind of bled off. Everybody from JP Morgan to Citibank, Wells Fargo, and so forth. And they screamed up so fast because rates jumped from just under 1% to 1.75% for that 10-year rate. Now that we've come back down into the 130s, I don't know how fast we get back towards that 170 in the 10-year, but I think that's more likely than 1% is from the level we're at. And a move to the upside in rates would be great for the banks. So that would be one sector I'd really watch. Another would be healthcare, because a lot of procedures, whether it's back surgery or other types of implants for knees and so forth, those were put off dramatically because people didn't want to go into the hospitals during COVID peaks. And the hospitals, quite frankly, were a bit overwhelmed and couldn't do as many elective procedures during the past year, 2020. So I think a lot of that backlog, again, pushes demand up in healthcare space.
What about a bet on the recovery of travel stocks here, John? Would you be looking at airline stocks, cruise ships, hotels? Is that looking good?
We did look at those, Daniela, in the more recent past, I'd say like 4 and 5 months ago. Right now, I'm sanguine about it just because, as you and I spoke before the show, I just came back from an overseas trip. The plane was half empty on the way back, which is kind of sad. A big Dreamliner half full. And the reason is, of course, combination of people uncertain about which countries they can get into and how easy it is to move in and out of those countries. We've seen long queues in Great Britain, for instance, of people when they're trying to come through border control. Most of us don't want to put up with that. And so that's been causing what would otherwise be red hot demand for overseas travel to moderate. So instead of that, I would say, watch growth stocks, because as inflation picks up, these growth stocks are going to just rock. Apple has been just killing it lately. And just a day ago, you and I saw that they told their suppliers, this is an insider that said this, but it's being widely carried. So I'll feel free to share it with you and your viewers, that Apple's telling suppliers 20% more iPhones this year. We need more. That would push them up over 90 million iPhones on this new introduction, which whether they call it the 13 or whether 13 is not a lucky number for Apple, I don't know. But certainly it's lucky for shareholders because we just keep hitting all-time highs for Apple after sort of biding our time and trading sideways for the first half of 2021.
Yeah, where do you think that boom is coming from? Where's that demand for more iPhones coming from, John?
Combination of people's old iPhones being just that, old, and people want the 5G. Last year was the first time they could have got a 5G iPhone. They could get, of course, a 5G Samsung or other, but Apple didn't have a 5G offering until this most recent. And I think this is all the folks that didn't already upgrade, a lot of those will be very much interested in jumping in now because there's greater distribution of 5G networks. And I think a lot more people want that, whether it's just for using their phone as a hotspot or whether they actually need it, because the more data we're pulling down, the faster the service is, and 5G is definitely faster. I think that's pushing consumers towards that 5G iPhone.
Let's just wrap with this,
Sure.
John. A lot of our audience is interested in the fringe assets of gold, silver, the cryptocurrencies. Are you liking any of the commodities right now or cryptocurrencies?
I like crypto. So given those sectors you just discussed, I'd take crypto first. I'd take, as far as commodities, oil over gold at this level, because I think demand, again, is what's pushing up prices for all kinds of refined products, diesel as well as gasoline. And I think that puts the demand on those products, lifts those higher. I think gold kind of moderates between 1750 and 1850 to the ounce. But I think crude oil, on the other hand, pushes towards, but doesn't get to $100 per barrel.
John, just finally, I know you were in Europe, you mentioned it. What was was the vibe like there? I mean, I live in New York City the remainder of the year, and I mean, things are just in full bloom there. What was the vibe like in Rome where you were?
It was great. I mean, people were out, and it's a little stricter in Rome about wearing masks in shopping areas. And when you come into a restaurant, but as soon as you're in and you sit down, you can take off the mask. But as far as shopping, they were being pretty strict, and there were testing centers everywhere. And that was a little lucky for me, Daniela, because as you probably know, when you travel outside of America, you come back in, you have to have, even if you're vaccinated, and I am, you have to have a negative COVID test. They'll do either molecular or antigen. And those are quick and easy, and they were like 20 euros, I think, but they had literally tents everywhere where you could do those COVID tests and get the results back probably in about 2 hours, unless you wanted to pay out.
All right, good insights. Well, I'm glad you had a good time despite all those regulations.
Sure.
Thank you so much. Jon Najarian, come back anytime, stansberryinvestor.com.
Thank you. Great to be with you again.
And thank you all for watching. If you want more exclusive content and videos you can't get anywhere else, sign up free at danielacambone.com. That's it for me. I'll see you soon.